Joining us now to talk more about their outlook for the economy and the financial markets, Millan Mulraine, economist at TD Securities, and Kate Warne, investment strategist at Edward Jones. Welcome to both of you. Millan, let me start with you. This jobs report today caught some people by surprise in its weakness. What do you expect for the job market over the next, say, 6 months?
Well, I think at least over the next 3 months or so, one can expect a significant slowing as the fallout from the government shutdown and the uncertainty about the debt ceiling continue to wreak some havoc on business confidence and business hiring and investment decision. But I think once we move beyond December and January, if we get the political stalemate resolved with this conference committee that has been set and mandated to come to an agreement by December, I think the fundamentals are in place for us to have a sustained push higher, which is unlike what we've seen over the last 2 or 3 years. The fiscal uncertainty has continued to stifle this economic recovery and has ensured that we haven't been able to sustain a higher push in employment growth or economic growth.
Kate, let me get you in on this conversation because it's pretty amazing what's going on in the stock market, even though the economy is not growing much. You know, the way it usually used to work was the economy would pick up and grow, and then the stocks would go up. Now stocks are going up, even though the economy is weak. Are these record highs justified?
I think they are. We've seen, obviously, 4 record highs in a row. And historically, when stocks have reached new record highs like they just did, we've continued to see stocks move higher. They need to be supported by economic growth and by job growth. But keep in mind that we've seen an average growth rate for the economy of just 2% per year for the last 4 years. And that's been sufficient to support higher stock prices over that 4.5-year period. I think we'll continue to see more of the same. The economy looks like it's stuck in sort of first gear, more of 2% growth, certainly hindered by uncertainty, but it's strong enough that it should support continued high stock prices.
You know, Kate, Millan and a lot of other people that we've been talking to seem to think that all of the hesitation and the policy by lurching from crisis to crisis is fundamentally a tax on our economy, a tax on growth, because it restrains business leaders, it restrains consumers. Do you see it that way? And how much is it really hurting the economy and hurting, for example, job growth?
I think it's hurting the economy in 2 ways. It's not just, and I wouldn't quite call it an attack. I think it's undermining confidence.
A tax.
No, I think it's undermining confidence, and that does reduce hiring. It does reduce overall economic growth. But there's a second way, which is the cutbacks in government spending, as well as the higher taxes that all of us started paying this year, are actually reducing overall economic growth by about 1% right now. So the private sector, even though it didn't hire very much in September, is growing closer to 3%. So I think there's 2 ways. We'd see even stronger private sector growth if we weren't constantly being worried about what the government would do next and whether rules and regulations would keep changing. So I think it's as much the rules and regulations changing as it is the other things that you've already talked about.
What do you think, Millan? What is it going to take to get this economy really growing again? And you just heard that Deloitte survey that consumer spending is supposed to be up something like 9% this holiday season. What kind of shape is the consumer really in to be a driver for this economy?
Well, you'll be surprised if I tell you the consumers are in their best shape they've been in about 5 or 6 years. For the simple reason, if you look at the household balance sheet, they are far better than they were 2 or 3 years ago. And what we've seen over the past year is higher home prices and higher equity prices. Whether or not you want to question whether the sustainability of that, they have pushed consumer household wealth to close to record high levels, and that will underpin some improvement in spending that we expect this holiday season. I think 9% might be a bit toppish, but somewhere closer to 5 or 6% would clearly be justified by the fundamentals that we've seen and the improvement in those fundamentals over the past year or so.
Kate, are stocks cheap or not?
Stocks aren't cheap, but they also aren't expensive. Stock price-earnings ratios for the S&P 500 are about in line with their average level for the past, since 1980, for the past few years.
So you're comfortable buying?
Yes, I'm comfortable buying. And the reason I was going to say that is the average doesn't sound too good, but historically, if price-earnings ratios have been average, the return over the next year has been about 9.5%. So that says, yes, stocks look like the best choice for many investors at this time.
So are you saying definitely time to get out of bonds right now?
No, I'm not saying time to get out of bonds. I think that most investors sitting on the sidelines should be putting money to work in both stocks and bonds. But I think stocks have the edge because we're likely to continue to see a moderate economic growth. I think we could see a catalyst from the rest of the world as Europe and Japan pick up. And that says stocks are likely to outperform. People need to own bonds because, remember, stocks pull back periodically and bonds help buffer portfolios.
Millan, very quickly, 2014, what is your growth forecast for the U.S. economy right now on October 22nd?
Well, we have a fairly constructive view on the growth projection for 2014, and I think we're likely to see another year of two halves. The first half driven by political uncertainty, and if we do get that political uncertainty resolved, we think we would be in the clear for the economic recovery. And you can see growth of 3% plus beyond the first half of next year, and that can push higher to 4% in 2015, which would bring the Fed back into play.
That's pretty nice. 3% next year, 4% the year after. Folks, thank you very much. Millan Mulraine, economist at TD Securities, and Kate Warne, investment strategist at Edward Jones.